Well, there's been a lot of talk lately about the US Treasury possibly revaluing America's gold, using an old accounting line, and somehow creating spending room without asking Congress for another round of borrowing authority. So in this video, we're going to separate the real mechanism from the rumor cloud, and you are going to walk away feeling a lot smarter and a lot more confident about what this actually means. Today is Sunday, April 26th, New York time. Comment below what day and date you're watching from because this one changes depending on when you hear it. And if you value this kind of calm breakdown, support the channel by subscribing and commenting John A.G. Best. That's it, short and simple. So, here's the claim on the table. The United States owns a mountain of gold, and that gold is still carried on government books at a price that looks like it got trapped in another century. Now, when most people hear that, they immediately jump to the wrong conclusion. They think, okay, if Washington revalues the gold, then the gold price must instantly launch like a rocket. Maybe every coin shop reprices overnight. Maybe the dollar breaks by breakfast. Not quite. This is not that simple. But it is also not nothing. Let me show you what I mean. The first thing to understand is ownership. The Federal Reserve does not own the physical gold in the way people imagine. The Treasury owns the gold. The Fed carries a gold certificate account, which is basically a paper accounting item tied to Treasury gold, not a stack of bars sitting in the Fed's basement. And according to official public data, that certificate line is still tiny, compared with the market value of the gold behind it. The Treasury's gold is carried at roughly $42 per fine ounce, while gold in the real market has recently been trading in the high thousands after briefly pushing above the 5,000 zone earlier this year. So right away you can see the gap. On one side, you have an old statutory value. On the other side, you have a modern market value. And between those two numbers sits the entire reason people are suddenly talking about revaluation. If the Treasury were able to tell the Fed to mark the gold certificate closer to market value, the Fed's asset side would rise. And when an asset rises on a balance sheet, something else has to rise too. That is not politics, that's accounting. The argument is that the matching credit could show up in the Treasury's account at the Fed. Think of it like the government's operating account, not exactly your checking account, but close enough for the bathtub version of the story. So, in plain English, the government would not be mining new gold. It would not be discovering hidden bars. It would not be raising taxes in that moment. It would be recognizing value that already exists on paper, but is not being used in the way market value would suggest. That is why this gets connected to the debt ceiling. The debt ceiling is not a spending bill. It is a borrowing limit tied to bills Washington has already agreed to pay. When Treasury reaches that limit, it can shuffle cash, delay certain moves, and use extraordinary measures for a while. But eventually, if the limit is not raised, the pressure gets real. So gold revaluation becomes interesting as a bridge, not a solution. A bridge. It could create temporary room without issuing new Treasury securities. It could give Washington breathing space during a political fight. And because the United States holds such a large official gold stock, the numbers get huge very quickly, even when you round them down. Now, this is where I want to be careful because there are two bad takes floating around. The first bad take is that this is impossible nonsense. I don't think that's fair. The gold certificate account is real. The statutory valuation is real. The difference between book value and market value is real, and governments absolutely do use accounting tools when normal political pathways get jammed. The second bad take is that this would instantly make every gold holder rich. That is also too easy. A revaluation would not directly change mine output, jewelry demand, central bank purchases, ETF flows, futures positioning, or the physical bars moving through global bullion markets. Gold is priced globally. It does not wake up every morning and wait for one Treasury accountant to tell it what to do. However, the psychological effect could be very different, because if the United States, the largest official gold holder on Earth, suddenly says, actually, maybe this gold should be recognized closer to today's market, that sends a message. And the message is not subtle. It says gold is not just tradition. It is not just decoration. It is not just something old governments used before modern finance got clever. It is still a monetary asset, whether officials like saying that sentence out loud or not. That is the real story, not the spreadsheet, the signal, and signals matter. Based on recent market updates, central banks are still buying gold even after the price moved sharply higher. They bought hundreds of tons last year, and early this year the buying did not vanish. It slowed in places, rotated in places, but it did not disappear. That tells you something. Central banks are not buying gold because they saw a flashy thumbnail. They are buying because reserves are about trust, access, politics, liquidity, and survival. And after Russia's reserve assets were frozen in the West, every finance ministry in the world learned a lesson. A bond can be safe financially and risky politically at the same time. A foreign reserve can be liquid until somebody decides you are no longer allowed to touch it. Gold held at home is different. It has no issuer, it has no counterparty. It does not need a payment rail to approve a transfer. It is awkward, heavy, expensive to store, and still somehow that is exactly why countries want it when trust starts leaking out of the system. Now don't misunderstand me. Gold is not magic. It pays no interest. It can fall hard. It can sit there for years and frustrate impatient people. And if a country needs spendable currency tomorrow, gold still has to be sold, swapped, or pledged. But as financial warfare becomes normal, gold's old-fashioned design starts looking less old-fashioned and more strategic. That is why the revaluation discussion has energy. It is not just about one administration. It is not just about Trump. It is not just about a debt ceiling fight. It is about whether the United States is finally being forced to admit that the metal it quietly holds still has monetary meaning. And this is where the political side comes in. If a Trump Treasury wanted to use gold revaluation, it would probably not announce it as panic. Nobody in Washington wants to say, hey, we are using the gold because the fiscal machine is stressed. That would be terrible messaging. They would likely frame it as modernization. They would say the old book value is outdated. They would say public accounts should reflect reality better. They would say other countries already treat gold closer to market value, so America is simply catching up. Same move, totally different story. And markets react to stories. If the public hears modernization, maybe the reaction is calm. If the public hears emergency money creation, maybe the reaction is very different. That's why the language around the announcement would matter almost as much as the accounting entry itself. Now, there is one more detail people miss. The official gold certificate line on the Fed's balance sheet is only around the low 11 billion area. That's tiny next to the market value implied by the Treasury's full gold position. And that is why a small-looking accounting line can produce a giant conversation. The line looks boring. The gap behind it is not boring at all. And the Treasury Gold Report makes the same point from the other side. The government lists fine ounces, locations, and book value, but book value is not market value. That's the key. Book value tells you the legal accounting convention. Market value tells you what the world is willing to pay. When those two drift apart for decades, you eventually get this exact debate. This also explains why the public reaction could be so strange. If officials announce a revaluation, some viewers will think the United States just discovered new wealth. It didn't. The gold was already there. Others will think money was printed from nothing. Not exactly. The government would be monetizing an accounting gain tied to an existing asset. That difference sounds technical, but it matters. It matters because investors price credibility. If a household marks up an old asset to borrow against it, the bank asks whether the asset is real, whether the value is fair, and whether the household is doing this because it is strong or because it is stretched. Markets would ask Washington the same thing, and right now those questions are already in the air. Deficits are large, interest expense is heavy. The Treasury market is still the center of the global system, but it is no longer a market people can ignore. When debt keeps compounding, even friendly investors start asking what the long-term plan really is. Gold revaluation would not answer that question. It would buy time. And sometimes governments value time more than almost anything else. Time lets Congress argue. Time lets cash balances rebuild. Time lets bond auctions continue under less panic. Time lets officials hope the next quarter looks better than the current one. But time is not reform. So if this move ever happens, I would look past the first headline and ask what comes next. Do they use the breathing room to fix anything? Or do they use it to postpone the same fight? That is where the real judgment will come. One clean revaluation tied to transparent accounting is one thing. Turning gold into a recurring political escape hatch is another thing entirely, and markets will know the difference. The danger is that people will confuse an accounting unlock with real productivity. It is not. It does not build roads, lower entitlement costs, improve tax collection, or make borrowing cheaper by itself. It simply changes how an existing asset is recognized. Useful? Yes. Powerful? Maybe. But if the spending problem keeps growing underneath it, then the shiny accounting move only covers the crack for a little while before pressure returns again later, with even less patience from investors watching. Now here's the counterpoint. If Treasury used this as a workaround, bond markets might not love it. Some investors could see it as another sign that Washington has run out of clean options. The Fed could face pressure about independence. Congress could complain that the executive branch is routing around the borrowing limit. And dollar traders could ask whether gold revaluation is a strength signal or a stress signal. That is the part people skip. A gold revaluation could be bullish for gold psychology and still uncomfortable for fiscal credibility. Both can be true at the same time. This is not a cartoon where gold wins, dollar loses, everyone claps, and the story ends. It is messier. If you're successful, share your success story in the comments so others can stay motivated. So, what should investors actually watch? First, watch the language. If officials start saying gold is an under-recognized reserve asset, that matters. If they start talking about updating old accounting rules, that matters. If they keep saying the current valuation is just a harmless legacy item, then maybe nothing is close. Second, watch the Treasury cash account during debt ceiling pressure. If cash starts getting tight and political negotiations freeze, strange ideas become less strange. Third, watch central banks. If they keep buying through volatility, that confirms gold is not just a retail fear trade. It is official reserve behavior. Fourth, watch the dollar reaction. If gold revaluation talk appears and the dollar weakens sharply, markets may be reading it as fiscal stress. If the dollar stays firm, they may be reading it as accounting modernization. And finally, watch gold itself. Not just the price, but how it reacts to bad news, strong dollar days, high-rate fears, and geopolitical shocks. Strong assets reveal themselves by what they refuse to do when they should be falling apart. So, how likely is this? I would not put it in the guaranteed bucket. Anyone telling you it is certain is getting ahead of the facts. But I also would not put it in the impossible bucket. There is too much real plumbing here, too much political usefulness, and too much global interest in gold to laugh it away. The better view is this. Gold revaluation is a pressure valve. Maybe it gets used. Maybe it stays on the shelf. Maybe officials only talk around it to remind markets that the United States still has assets other than debt promises. But either way, the conversation itself is revealing. For decades, the official message was that gold was old news. Interesting historically, useful symbolically, but not central to modern money. Now suddenly, the same gold is being discussed as a way to create fiscal room, signal reserve strength, and answer a world that is slowly diversifying away from total dollar dependence. That's not nothing. And if Washington ever moves on this, the most important moment may not be the accounting entry. It may be the day ordinary Americans realize the government never abandoned gold. It just stopped explaining why it still kept so much of it. That realization could be powerful. Because once people understand that gold still sits inside the system, the next question is obvious. Why? Why carry it at all if it doesn't matter? Why guard it, audit it, report it, and keep it if it is only tradition? And why would foreign central banks keep adding to it during one of the most complicated monetary environments in decades? Those are the questions that matter, so don't get distracted by the loudest version of this story. Don't assume revaluation means instant riches. Don't assume it means immediate collapse. And don't assume the old accounting price tells you the full truth. The truth is more interesting. Gold may not need the government to make it important, but if the government starts admitting it is important, that changes the room. And when the room changes, markets eventually notice. This content is for education and perspective only, not personal financial advice. Your money should never move because a story sounds exciting. Study the facts, understand the risks, and make decisions that fit your own situation.